All right, so DuPont analysis, right? We've been going through this one. So, where is, wait, is it? Okay. DuPont analysis is the one we've been talking about, okay? ROE, right, is decomposed into three components, right? Um, Net margin, and then we call this guy asset turnover, and then this one asset over book value of equity. I would say 1 plus leverage ratio kind of things. Okay, why is that the case? Because asset is debt plus equity, and this guy is equity, right? So this guy will be 1, okay, and this guy will remain. So debt plus debt over equity plus 1, just book value based one. This one essentially tells us about the financial leverage anyway. Okay, so leverage, and then the margin, and then the turnover, right? Turnover, how can we understand this one? Well, they're in I see, but I'm on fire. The YG, right? Do they belong to YG or JYP? I don't know. But uh, when it comes to those 연예기획사 or entertainment companies, they have 연습생, or they have a lot of singers, right? Singers are their assets. And then based on one singer or one girl group or boy group, how much of a sales do they generate? How many rounds of 공연 or the performances do they run around? Okay, some 연예기획사, okay, treat those singers like a slave, so that they have to run around so many different 공연s, right? That's high turnover. Okay, you can achieve high ROE through torturing them, like go sing, go dance, and then turnover rate will be higher. Okay, that's one of it. I'm not encouraging them to do this, but this is one way they do it. Another way of achieving high ROE is like having high leverage. Okay, compared to your equity value, you borrow more money. Okay, you leverage up. Of course, you will get more risky, but when it hits a jackpot, you will hit like crazy high. Okay, all the profits will go into equity holders' pocket. So that's why leverage ratio, okay, will increase your ROE. And then last way, or the more important way, okay, most important way of achieving high ROE is claiming or getting high profit margin. Oh, this is the best girl group. So, or one singing, okay, you have to pay us 1억 won or 100 million Korean won per singing instead of 10 million Korean won, 1천만 원, right? So, for the same sales, they generate more profit out of it. Okay, how can they claim this kind of high profit margin? Well, you need to have strong brand equity. That's where your marketing comes in. If you have strong marketing ability, so that you have loyal customers. Oh, BTS! Everybody goes crazy about BTS, so much so that they may want to come to Korea even at this COVID-19 crisis kind of things. If you have that kind of brand equity over there, you can charge higher margin, okay, for each singing. That's the idea. Clear? So 3 different ways of achieving high ROE, right? Margin, turnover, leverage. Which one, okay, contributes to our ROE? You have to analyze it. And DuPont analysis give you some clear idea about it. So I encourage you to use DuPont analysis using your historical data as much as possible. Go back in history as much as possible, and you will be able to see how the management or the CEO has been achieving those ROE performances. Now, you can modify this formula in your own ways. Right? I told you this is mathematician's favorite technique. Any ratio, numerator, denominator, separate it and multiply and divide by the same number. How many times, it doesn't matter, it's up to you, okay? But ROE, okay, separate it and then multiply and divide by the same number. This time, instead of assets, just, IC, okay, could be there, invested capital, which is essentially the same as assets anyway, that I told you before, but this is more explicit way of doing it. Instead of asset turnover over here, I would just label it as IC turnover, invested capital turnover. For a single dollar of invested capital, how much sales did you generate? Okay, this will be it. Now, you could apply this kind of decomposition analysis in ROC setting as well. How? Well, let's start with the ratio, which is NOPAT divided by invested capital. Then separate it out. Multiply and divide by the same number just one time. Sales. All right? Then the first component tells us about profit margin, NOPAT margin. Okay? The same idea as this one. Instead of net margin, you just have NOPAT margin. Okay? Over here, this is asset, the IC turnover, the same as this guy. Okay? That's it. Right. Next, expected EBIT growth. Just like ROE, ROC is closely related to the competence of the management, the CEO. It is a key performance metric of management, and this is why you need to look at the track record of the CEO in terms of historical ROC and ROE. Okay? In case you assume a significant restructuring with new business strategy, with replacing the existing CEO, kicking out and then bringing you guys, right? Bring new ROC or new ROE, you can assume it. But the same guy, staying there, keep it. You need to assume some new ROC associated with the new management team. All right. Now, ROC of Samsung Electronics and Hynix and Hyundai Motors are shown over here. They are hovering around the 20% range, up and down, totally kijegi. No, that's not. Semiconductor is much more volatile industry than car manufacturing, even in terms of ROC. Within semiconductor industry, Hynix has been much more volatile and spiky. You see the graph. A picture is worth 1,000 words. So, graph, okay, visualize all those things, please. Now, ROE of Samsung Electronics and SK Hynix and Hyundai Motors, those same three companies. Now, what I want to emphasize is the scale of the volatility. ROE is much more volatile than ROC. Okay, the slide before, 200. Okay, percentage range, minus 100 percentage range, right? And then the next one, the same scale, but ROE is much more volatile. Why would that be the case? Okay, why would that be the case? In any case, they capture the profit margin, they capture the asset turnover, or whether you call it asset turnover or invested capital turnover. But ROE is affected by one more element. What was that? That must be driving the volatility over here. That is financial leverage. Okay, you do business with borrowed money, then it makes you more risky. Risk does not necessarily mean bad things. Okay, of course there are some bad things when the economy tanks, like today's situation. Those guys with high leverage will go bust. They'll go to hell, right? But in good times, okay, they hit the jackpot. They still owe a little bit of amount of money to the bankers. Repay them. The remaining jackpot amount is all equity holders, profit. So that's why it is much more volatile, more up and more down. Leverage creates all this kind of things, right? So the mathematical relation between ROC and ROE is like this. Okay, ROE should be ROC plus, okay, debt to equity book value based ratio times ROC minus 1 minus tax rate times, what is this? This is book value based interest ratio, interest rate kind of things. Okay, this is historical interest rate. Okay, so if you do the math, you will realize ROE should be ROC times something greater than 1 minus this guy. Okay, and this is the leverage effect. Okay, makes this more volatile. I mean, I should say this one. Okay, leverage effect magnified. So that's why it is much more volatile. Anyway, ways of estimating growth rate in earnings. Again, 3 different ways. Look at the past, look at what others are estimating, and look at the fundamental relations. You have a choice of doing it. Okay, that's all that I'm trying to say. Now, expected growth rate in Ebit and the fundamentals, stable ROC and reinvestment rate. Okay, if you assume it, then what happens? Reinvestment rate, okay, should be like this, which is your investment amount divided by NOPAT, right? And then growth in Ebit should be this. Repeatedly, I tell you this. And then Cisco, okay, Cisco, San Francisco. This is the WebEx company. You're using WebEx for our class discussion, not in my class, but other classes, right? Instead of Zoom. So Cisco, San Francisco is the company of WebEx, right? And this company, a telecom company in 1999, their expected growth rate in Ebit looked like this, 36.93%. Where did it come from? Reinvestment rate was like 100% or more times return on capital of 34%. You multiply this guy, you get 36% growth rate. High reinvestment, the intuition. High reinvestment, more than 100%. Crazy! Reinvest everything! More than what you earn in your NOPAT, okay? Which means raise capital and then throw in everything over there, right? High reinvestment, high growth, okay? Low reinvestment, low growth. Motorola, well, that was a cell phone company when you were born, okay? Time immemorial, I guess, right? 조상님 시대 kind of. Motorola was kind of ruling the world of mobile phone, okay? When the mobile phone was like brick-sized, a huge size, right? They were dominating this cell phone market, so that they got complacent. They did not reinvest as much, 60% or less, and then return on capital was very low, laxly managed, right? Stupid CEOs, right? No growth. That's the intuition over here. Anyway, so that's that. Well, can you bring us some kind of real case so that we could apply those ideas to real companies? Here we are, okay? So, value Netflix, okay? Netflix. Who does not watch Netflix these days, right? My wife and my daughters, they subscribe to this Netflix and they keep on watching and watching and watching at home, all right? I don't have time to watch this thing, but I know they enjoy this thing. Believe me, I don't, because I have to prepare this class. But at least COVID-19, okay, is a disaster for most of the companies, but unintended consequence, or not unintended consequence, but there are some group of companies that are benefiting from this disaster, right? Unintentionally. That's Netflix, one of them, and then Zoom or Cisco kind of companies, I guess, right? Network-based companies. .com, not just not .com, but network-based untact business, they call it untact instead of contact, right? So since COVID-19, Netflix seems to be flying high. Why? What is their fair value? Okay, we're going to use FCFF to value Netflix and determine whether to buy or sell. But this is not a full commitment. So disclaimer, right? I'm not responsible for the consequence. This is just one way of estimating value in a very rough way as a baby step. Baby step. Okay? Um, in practice, you would have to do a lot more study than this one. I'm going to tell you what aspect of study you need to do in addition to this one, right? Wait for that. We're going to use FCFF. Why FCFF? Their market value based debt to equity ratio is rather stable over their history, and they don't seem to have any refinancing schedule or significant at this moment. So we can safely assume their capital structure will be similar, okay, into the future. Now looking at the big picture a little bit, and then today's performance, the stock $431 per share. Okay, $431 per share. Holy cow! Market cap is like what? 109, almost $90 billion. Like Ebit one company. Ebit one company. How big is that? I don't have a magnitude about it. Is it close to Samsung Electronics or something? A fraction, maybe. Close to Samsung Electronics, I guess. So you generate so many semiconductor, billions of them, and still get the same amount of market cap. Who creates a lot of network-based movie subscription, right? So which is better? I don't know. Okay, a high-tech company. Okay, is it a good time to buy Netflix, or is it a time to sell? Right? If you look at their historical stock price ever since 2000 or something, right? There has been exponential growth in stock price. Netflix, like this. So, shall we buy it, or is it in a bubble so that their fair value or the true value is here maybe, but it is overpriced right now so that we have to sell it? Okay? Where is the true value? Is the true value way up there or way down there? Or is this the true value? Buy or sell. Right? Sad reality for all individual investors, Cammy, like you and me. The price starts to go down after I buy, and it starts to go up after I sell. And then if you're married, your spouse will just smash you. Why did you buy it? Or why did you sell it? My wife will keep on doing that to me. Right? Let's have some big picture before that, right? And then try FCFF valuation, right? Big picture, okay? Big picture first, and then get to small part later on. So Netflix. First of all, the CEO, Mr. Reed Hastings. Okay, he looks like this. Have you ever thought about the CEO of this company, right? Reed Hastings, the co-founder and the CEO of Netflix. He owns 1.3% of Netflix. Okay, which went public in 2002. Hastings co-founded this company in actually 1995. So from 1995, okay, to 2002, 7 years period, they were private companies. Next week I'm going to talk about private company valuation. Wait for that. IPO may be there. The same year he sold his first company, Pure Software, Rational Software. Okay, so he's MIT graduate or something, a tech guy, and then used to be the code debugging company, Pure Software was like that. But he switched into different industry. The video streaming service offers TV shows and films as well as original content to 100 and almost 40 million members globally. Okay, do you belong to one of them? My wife and my daughters belong, right? Netflix originally operated as a DVD subscription service. I remember this, guys. because in Minnesota, when I was studying an MBA program, there was Netflix mail coming to my home, and advertising there. DVD subscription. You want to do it? I did not have time to, because I had to study like crazy, in PhD as well, and I almost forgot about Netflix as just still these days. The picture that I remember as Netflix is like that mail, right? But began streaming contents in 2007, and then giving pledge members. He founded Hastings Fund recently and pledged $100 million to children's education. So this is his way of contributing back to the society as a CSR, I guess, right? Good, right. So it looks like this, right? This kind of information you can get it from Forbes. Has been there and will be there, right? Uh, okay. The next is Netflix sales. First big picture is sales, right? A metric, right? I mean, the CEOs, if you talk to them, right, they brag upon their size of the company. I manage the X billion dollar sales of company. Instead of I manage what $1 billion worth of market cap company, right? Sales. Anyway, why is that the case? Market cap is available for public companies only, publicly traded companies only, whereas sales, you can tell it even throughout the private companies, millions of private companies. So it's more common denominator in discussion. So their sales ever since 2000 and 2019. Why don't we have, you said, 1995 it was established. Why don't we have sales figure in 95 all the way up to 99? Okay? This period is missing because when you are a private company, you don't have a chance to disclose your sales. Nobody pays attention to you. And then the regulators, 금감원 kind of guys in the US, SEC, Security Exchange Commission, they don't disclose your sales figure to the public. Okay, they just collect it, but it's just not available. But once you do the IPO at this 2002 point, right? IPO, okay, your accounting data starts to get disclosed to the general public. This will be important for next week discussion, right? IPO, once you do it, everybody has to know about your company, so they publicize it ever since your sales figure is a public information. But interesting thing is, are these two information, sales and sales over here? You said IPO, you did it over here, but how come the previous period over here, the sales figures are available, even though it is when Netflix was a private company? You're right. How come? Well, at the time of IPO, the Netflix company had to disclose their past track record up to 2 years before their IPO time, right? So much so that when you do the IPO, the public investors will pay attention to you and look at, I should draw my eyes over there. Pay attention to your accounting reports. 3 years worth of accounting report, 1, 2, 3, right? So that they will have some good understanding of your business. So your sales figure, accounting figure starts to be disclosed and become available 2 years prior to your IPO. Good, so that's that. And then more important thing is the big picture. What do you see? Exponential growth, right? Good. Then, not just this guy alone, but the sales of competitors or close guys in the ICT, right, are shown over here. What do we have? Well, I picked, okay, it's just my subjective judgment, okay? Don't you have to be absolutely objective? No, I'm not an accountant, right? Good luck, right? Amazon.com, right? Who disagrees? Amazon is not, is a competitor of Netflix in this world these days. So let's look at it. Tech company, Google, yeah, YouTube versus Netflix. I subscribe to YouTube. Not only that, I'm a YouTuber, believe it or not. Um, Somebody has to click my videos, but they don't. But still, Netflix, yeah, competitors. And then Dish Network, what is it? This one was cable TV, is a cable TV kind of guys. They were using the satellite antennas, right, to transmit their television network, okay, broadcasting, Dish Network. And then here is Disney, Walt Disney, okay, Universal Picture, you went there, right? And Disney is over here, right? Walt Disney. Why do I compare this guy? Isn't it theme park only? Mickey Mouse and Donald Duck? No, their cable television is a significant division. And then at one point, this guy Hastings told us that he want to compete with Disney, so I'm just putting them over there, right? So sales, I forgot to turn on my dog, so I have to finish somewhere. Anyway, so sales, it's exponentially growing, and let's trim down to our close competitor in the broadcasting business, maybe Disney, and then Dish Network and Netflix over here. Google is there, but it's way above, and YouTube is a fraction of it, so I just took it out. But the message that I'm trying to deliver over here is that it seems like there's a lot more room for Netflix to grow.
편한 상태로 쉬고 있습니다. 정신은 초롱초롱하지만요.
Okay, I should shut my mouth up, so I'm gonna stop.